Hello and welcome to another video of Eternal Gains. This is the channel where I show you how to grow your stack in the most sustainable and most safe way. Today we're going to talk about Volmex. What is Volmex? What does it do? What we can do with it and all of that jazz. Let's get started. So Volmex is tokenized volatility protocol. Okay. What does this mean? If we enter the app, then you will be presented with this screen. I mean, to be honest, it doesn't look very, fancy or anything, but it is pretty useful, as you will see in a second. Now, what you can do here is mint volatility tokens, okay? So what we are doing right now is basically providing liquidity for this protocol. You can either provide liquidity for this protocol, or you can use these tokens, what I will explain in a second, to hedge against volatility. Okay, let's start. What is volatility actually? If you're familiar with the stock market, then I'm pretty sure you have seen or you have heard about the VIX index, volatility index, which is measuring the volatility. So basically the movement up and down of the stock market. Okay. For example, if you take a stable coin will move something like this, right? So very, very gently, just a little bit up and down, but it will stay more or less the same, right? Now, if you would take the volatility of this one, then the volatility for a stable coin which moves like that would look something like this, right? So pretty flat, nothing much happening there. But if we take, for example, Bitcoin, which is the exact opposite, Bitcoin does something like this, right? Goes all over the place. So if you would measure the volatility of something like Bitcoin, then also the volatility would be quite like, would move a lot, okay? Compared to, for example, a stable coin, okay? So volatility, all it does, it measures basically how much something moves up and down, how extreme basically the movements up and down, right? If you want to go in the nitty-gritties of volatility and how to calculate it, you will find plenty of resources online. Just Google for volatility calculation, and you will find explanation on how to actually calculate the volatility. Okay, either way, so the VIX, for example, in this case, measures volatility, okay? So you can see it's like, in January, it's coming down a little bit, okay? We had a little spike now at the end. But all in all, volatility is coming down, but you always have the spikes in between. And this is basically when the stock market went up or down pretty steep and pretty fast, okay? Okay, so what we can do with all of that? What Volmex is offering is you can basically hedge against volatility. Why would you want to do that? Let's say you are long Ethereum, which means you bought Ethereum, okay, and you're hoping the price goes up. Now, in times of a lot of volatility, it might be good to have sort of an insurance, right, against this heavy movement of the price. So what you could do is you could come over here. Actually, in this case, you would need to come over here, and you could buy this Ethereum IETHV, okay, which is the inverse Ethereum volatility token, okay, which means this one is moving inverse to the volatility. So if volatility goes up, obviously this token value goes down, and vice versa, right? So what it means is, for example, if the price is very volatile, which means it goes up and down like crazy, then this coin would basically hedge you against this volatility. So it gives your portfolio basically more stability, okay? So for example, there's something called drawdown in a portfolio, which means if you own, let's say, only Bitcoin in your wallet, okay, then obviously your value, the value of your wallet can be, you know, plus 50,000 today, and then 30,000 tomorrow, and then 40,000 the day after. So it's very volatile, right? The value moves a lot. But if you would now buy this inverse volatility token for Ethereum in this case, then basically it would balance out those times of extreme volatility, because if volatility goes up, then the token price goes up, okay, while basically your portfolio value is going down. So then basically the values of the inverse of the volatility token and your portfolio value would balance itself, would balance out, okay? That's the whole idea behind it. Yes, so what they're offering is basically two tokens, the volatility token and the inverse volatility token, okay? If you come over here to their docs, then they have a nice example of how you can provide liquidity and how you can trade this token. Of course, we are farmers, so we are mostly interested in the liquidity providing section here. So what we can do is we can mint an equal amount of those liquidity tokens, okay? And since they are liquidity and inverse liquidity, of course, the overall value of those tokens always stays pretty much the same, right? Because if volatility goes up, then the volatility token gains value, and the inverse volatility token loses value, right? But like the sum is still the same at the end. So if you want to provide liquidity for this protocol, what we can do is we can use DAI or USDC and mint an equal amount of those two tokens, okay? If you come over here to QuickSwap and to the pools, add liquidity, let's come over to this Ethereum, to this token right here, then you can see that I already have some of those tokens. We are on Polygon, by the way, just for your information. My wallet disconnected, so you cannot see it, but I definitely have already an amount of this tokens. So what we have to do to provide liquidity, number one, we have to mint the two tokens, okay? I mean, it's one transaction, but you mint an equal amount of both tokens. And then you come over here to QuickSwap on Polygon, or they also have pools on Arbitrum and also on Ethereum mainnet. And then you simply provide liquidity for this token, and then we are earning fees on that. Now, what is this token actually used for? And this is now basically the trading side. As I explained before, it is to hedge against volatility. So Volmex Finance makes it easy for traders to express a view on the market volatility. Traders can purchase volatility index tokens and inverse volatility index tokens from spot exchange to speculate or hedge market volatility. And that's exactly what I explained before. You can hedge against volatility, basically protect your portfolio against volatility. Or on the other hand, you could speculate on volatility, which means in times, let's come over here to Ethereum. Ethereum USD. Now, times of low volatility would be something like this, okay? The price moves pretty steady. There's not much going on. High volatility would be something like this, up, down, okay? So let's say volatility is low, okay, somewhere here. Then you could buy those volatility tokens relatively cheap, right? And speculate that volatility will increase again. And then you could sell those tokens in times of high volatility, which means the value of this volatility token is up, okay? This is one way. This would be the speculation side. And as I explained, the hedging side would be simply to buy tokens in times of low volatility, for example, and if volatility is high, it simply balances it out against your portfolio value. Okay, and obviously inverse volatility is exactly opposite. When volatility is low, then the inverse volatility token would increase in value, and if volatility is high, then the inverse volatility token would decrease in value. Okay, I know it's a little bit complicated if you're not familiar with the concept of volatility, but also like most of the option strategies are based on volatility. For example, implied volatility, you have realized volatility. It's a whole big topic, but for us, important is that the idea of Volmex is really, really good because, of course, crypto is very volatile. So especially when you have a bigger portfolio, then it definitely makes sense to hedge against volatility. So I could imagine that especially bigger players could adopt this protocol. At this point, it's not too big, it's not too popular. It's a fairly new project, so there's also a possible airdrop on the table. Okay, so it might be a good idea to, to be early and to, of course, do your own research, look into it, do your own opinion. But I, for my part, just minted a little amount of those tokens and just provide liquidity on QuickSwap. That's what I do on Polygon. Of course, Polygon fees are low, so we can do this sort of experiments. So far, I'm testing it now for about almost a month. And so far, it worked pretty well. Yeah, I just wanted to bring this to your attention. If you're interested in volatility, in hedging, have a look at this protocol and also at the option to provide liquidity, which is pretty cool. Okay, guys, I hope that helped. If you have any questions on this topic, just let me know in the comments below. Smash that like button and see you in the next one.